How is it that you could be in the 12% tax bracket, but take a withdrawal from your retirement account and pay 30% tax if you're married and up to 50% tax if you're single? That's the tax torpedo, and that's what I'm going to show you in this video today. What I'm going to show you today will hopefully help you understand why tax planning in retirement is so complex. We'll have some of the brightest engineers in the entire world right here in Houston, Texas, come into our office and we start planning and we're looking at the taxes. And oftentimes they'll have their spreadsheets all laid out with projected income out many, many years. And then they'll have this little line that says taxes. And when we look at it, it's inaccurate. And the reason it's inaccurate, it's not because they aren't really smart people. It's because this tax code is complex. They don't quite understand where different sources of income start to torpedo other sources of income, and they don't quite understand where phase-outs start to take place and the math behind those phase-outs, which ultimately just means your deductions start going away at various levels of income. Not to mention, we have several different definitions of modified adjusted gross income, for example, in retirement that impact whether it's your ACA subsidy before you're 65 or Medicare premiums. So I'm going to show you an example of a married filing jointly return and a single filer return. We're going to show you some visuals so hopefully you can start to sink in, and at the end of this video you should understand exactly what the tax torpedo is. Okay, so we're going to start with the married couple, and to make this simple, right now the only income we have here, as you can see, is they have $60,000 of Social Security. Now I understand for most of you this may not be exactly your situation, but that's not the point. The point is to show you how these different layers of the tax code start to interact with one another, and this is the easiest way to do it. So we have total Social Security and then taxable Social Security. So Social Security is a preferentially treated source of income. It's only when you start to have IRA distributions or dividends and other sources of income that it starts to get complex. Now, we do have one thing up here, which is dividends and capital gains. So this is actually qualified dividends, and the reason I have this here is because there's actually a long-term capital gain and qualified dividend torpedo that I want to show you. So $60,000 of gross Social Security with $12,000 of dividends, $10,000 of which are qualified. Only $5,000 of that Social Security is subject to tax. Now, even though you have this $12,000 of dividends and $5,000 of Social Security that's subject to tax, your total tax is zero, right? Because you have your standard deductions. This couple is over the age of 65, so they have the enhanced senior deduction, which is an additional $12,000 reduction of income. So even though they have $60,000 of total Social Security, $12,000 of dividends, the total tax is zero. Now, here is where people often find themselves getting hit with this torpedo. So they'll see, okay, I have zero taxable income, I have my Social Security, I figured that much out, kind of look at the income tax brackets here where, well, I could withdraw more money to get to the top of the 10% bracket, or look, I could go all the way up to $100,000 and not leave the 12% bracket. Well, that's a mistake, and I'm about to show you why. Okay, here we have a visualization of the numerous tax torpedoes. So what this chart represents is what happens to you tax-wise if you take more money out of your retirement account, whether it's a distribution for income purposes or it's a Roth conversion. So this first gap right here, we can take between $0 and about $20,000 out, and that's still going to be subject to zero tax. Your taxes will not go up. You'll still be paying zero tax on all those distributions. But once we get here, let's look at about $25,000. So now you're only in the 10% ordinary income bracket, which is highlighted by the blue of this chart. You can see at the bottom of the grid there, it says taxes on ordinary income, 10%. But you're bringing Social Security from a state of being tax-free into a state of taxation now. So this $25,000 withdrawal, it is subject to 18.5% effective rate, even though you're only in the 10% ordinary income tax bracket. And as we take more money out, let's say we do a bigger Roth conversion, because we looked at those brackets and we said, hey, we have all this room before we get into the 10 or 12% bracket. If we take $43,000 out, now we're being taxed at 22.2% on these dollars right here. And that's simply because Social Security is going from a state of tax-free into a state of taxation. Now, once we've pulled out this much income, we're still now in the 12% tax bracket, but Social Security is further taxed. It can only be up to 85% subject to tax. So at this point, we've withdrawn so much that Social Security is at its maximum state of taxation. Every further dollar we pull out of the retirement account is going to be taxed at 12%. But look what happens here. We have this range between about $85,000 and about $93,000, let's say 92, where on that withdrawal, this is 85 to 92, about $7,000. On this $7,000 that's being withdrawn, it's being taxed at 30%, even though you're only in the 12% ordinary bracket. And if you can see as we go up the hierarchy here, it's because now those dividends that we discussed earlier, now they're being brought into a state of taxation, whereas previously they were tax-free. So we're paying capital gains on those dividends, but then we see Social Security, it's already taxed fully, it's not being brought in anymore. But then above that, it's the enhanced senior deduction. So the words are cut off there, but that's where it is. So what this additional 3.2% is, it's the effective impact on the taxes you pay because your income has crossed a threshold that forces your senior deduction to be phased out partially. So your deductions are getting smaller, therefore more of your income is subject to tax. When you add the 12% ordinary income tax on top of the 15% capital gains for those dividends, and then the 3.2% effective tax rate because of the phase out of the enhanced senior deduction, it all comes to about 30.2% tax effectively on these $7,000 that are being withdrawn. Now, technically, these first couple are going to be taxed at 27%, then 30%. And then once those phase outs are complete, now we're back down for a little bit to 13%. And then here we hit the next kind of torpedo where we're in the 22% bracket. And then we have a little bit more of a phase out of the enhanced senior deduction. Okay, so I went through that pretty quick and I hope you understood it. You may have to rewind and go back and watch that a couple of times. But if you have comments or if you have questions, put them down below because I really want to understand, one, did I communicate that clearly? Two, are you grasping it? But if there's anything further that maybe we could clarify in a future video, put something down below in the comments so we can address it. Now, I'm going to move to the single tax situation. And we did a video recently about the compression from when one spouse passes away, which is the most predictable planning event in retirement, but it's one of the things that are least planned for, that is least planned for in retirement. So when one spouse passes away, the following year, the spouse goes into the single brackets from married filing jointly. Everything compresses. The income tax brackets, the Medicare thresholds, the capital gains, the dividends, the enhanced senior deduction, everything compresses. So that same level of income minus the Social Security check often leads to a higher state of taxation or paying higher taxes. So we did a video recently on that. If you want to check it out after this one, go check it out. It's a really good video. But here we're going to look at the tax torpedo now for a single filer. Okay, so I've adjusted the Social Security here, but that's it. We still have the dividends, and Social Security now total is $40,000 with $12,000 of dividends. Only $3,500 of the Social Security is subject to tax. So this is a single filer. $40,000 of Social Security, $12,000 of dividends equals zero tax. Now, here's also your enhanced senior deduction at $6,000 for a single person versus $12,000 for married filing jointly. But it starts to phase out at half of the income than the married couple does. So the deductions, again, start to go away more quickly. So I just want to show you the brackets here. You can go back, compare it to the married filing jointly brackets, but you can see, if you remember, they're clearly much lower. They're compressed. This is the bracket compression we were talking about. So now the 10% goes up to $12,400. The 12% goes up to $50,400. In the married filing jointly example, this was $100,000. So again, this is where this might occur, where the tax torpedo kind of hits you. You're looking at your total tax owed. You're saying, okay, my adjusted gross income is this amount. You know, I can go all the way up to $50,000 here and still be in the 12% bracket. Oftentimes this would happen maybe when you're looking at your tax return, reviewing it with the CPA, and you say, you know what, this next year I'm going to do a Roth conversion. I'm going to take advantage of the space that I have for that next bracket. Okay, and here now we have the tax torpedo chart for the single filer. So same as before, these dollars, based on the income that we have, we can take these additional dollars out of the IRA up to about $10,000, $9,000, and still pay 0% tax on that distribution. So this is something you'd want to take advantage of for sure. But we see that the tax torpedo comes much more quickly. So if you take 12,000 out, that 12,000 is going to be taxed at effectively 18.5%. If you take $22,000 out for a conversion, that's effectively being taxed at 22%. But you're still, if you look at the blue at the bottom, you're still in the 12% ordinary income bracket, but same situation, because more Social Security is being taxed, effectively it's at 22%. Now, this is where the IRS really gets the single filer, and if you look at it, it's almost like they're giving you the middle finger, right? So an additional distribution here, if you take 33,000 out, 34,000, 36,000, it's just for those dollars, this $3,000-$4,000 span here, but it's being taxed at 52%, almost 53%. And that's the federal income tax. If you're at a state, this $3,000 or $4,000 withdrawal, this incremental withdrawal here, add another 3, 4, 5, 6% on top of it, depending on where you live. And it's because Social Security is now fully taxed, your enhanced senior deduction is completely phased out, and the capital gains are being taxed, the dividends in this particular example. And that's just because of the bracket compression. As a single filer, everything cuts in half. Okay, so you understand what the tax torpedo is now, hopefully. Now I'm going to tell you why it may not matter at all. Because sometimes when you're doing tax planning in retirement, most of the time, you have to decide, are you willing to pay more tax today in order to put yourself into a better position for the long term? And when we talk about bracket compression and one spouse predeceasing the other, this is one of the components you have to really look at when it comes to tax planning, because not making proactive decisions today leaves that tax risk on the table. What happens if one spouse unexpectedly passes away at 74 and the other spouse lives to 95? Well, that's a 20-year period or so where now you're getting crushed with taxes because you're in this state of bracket compression as a single filer. So when it comes to tax planning, you have to be able to model out all of these scenarios. You have to compare the opportunity cost of the dollars that you're losing if you're paying more taxes today for Roth conversions or more strategic income planning for distributions, because you're going to have to send taxes to the IRS, and how that benefits you long term. Does it put you and your spouse in a better position? Then you have to re-anchor all of those decisions. Every single time you make one of those decisions, you should re-anchor it to what's most important to you. You all have different goals. You have different things that you're trying to accomplish in retirement. Paying taxes or paying less taxes may not be as important to you as certain other things. Before you make those decisions, just understand there's a mathematical analysis and financial modeling and projections that should take place. But most importantly, you have to re-anchor those decisions each and every year that you're doing this planning to what's most important to you. Because it's easy to get lost in kind of the concept of we're planning, we're doing this, but you need to be able to raise the trade-offs against, or trade-offs of that decision against what's most important to you for your entire retirement. So, hope that makes sense, and I hope you understand the tax torpedo. If you have any comments or questions, put them in the comments below. We'll try to address them in a future video.